Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be analyzing Mondelez International stock, ticker MDLZ. This one came in by request down in the comment section of one of my other videos. If you have a request of a stock you'd like me to analyze on the channel, put it down in the comments. I will get the ticker on the whiteboard behind me and eventually I will make a video. This is going to be my second run of this video because I had like a coughing fit toward the end of my first run of this, so we're going to give it another try. And I have a lot of more stocks on the list there, but we're working our way through them. If it's a stock that's not in the S&P 500, I post those on Patreon, which is $5 a month, and also in the full Cyclical Investors Club service over on Seeking Alpha. Those links will be down in the description. And if you do join Patreon, you can get a big discount if you ever decide to join the full Cyclical Investors Club service, where I have all of my strategies, not just the two main ones that I talk about here on the YouTube channel. And then I track about 600 stocks that I've kind of pre-screened for quality. And then there's a chat room. You can chat with me. You can direct message me anytime. Usually I get back to people really quickly. And it's just overall a great place. We have a lot of investors there now that I've been, this is my 6th year of having the investing service, and we've really built up like some great members that find great stocks to look at and discuss. And so if you kind of like what I do here, that's a good way to learn more and become part of the club. Also, I have a 25% off link for fast graphs, which I'm going to use here for this analysis, down in the description as well. If you think it might be useful for you, it's pretty good for sifting through stocks pretty quickly, especially on that kind of initial look and doing some basic calculations to see if it's a business that you might want to own a piece of. As always, this isn't individual investing advice. This is just how I analyze stocks. Okay, let's get into Mondelez. So, packaged food business, right? Little bit of debt that I'll adjust for later, but usually the first thing I check is the long-term kind of earnings trend, and we kind of have two different phases, I would say, for Mondelez here when we just look at the basic fast graph. We have like 10 years where growth up until maybe 2013 didn't really do too much. It was just kind of flat, steady growth. But they also didn't lose much earnings during the recession. So stable but flat earnings growth. Then when we get a little bit closer to the last 10 years, earnings growth is a little bigger. Now this isn't not a log scale, so sometimes it can just look a little better, even though it's not necessarily a whole lot better, but it's not too bad here. And again, very steady, no major, though I guess 1% they fell this year, but they had a big year in 2014, the year before that. So basically, if you use the basic fast graphs method, which is what most people do, you look at the point of their earnings back, whatever date you choose, so the beginning of 2015 through today. I think fast graphs uses a blended version, so they might be looking forward a little bit and blending it right in here. But it's really like a point-to-point measurement, and they have about 7.5% earnings growth rate during this time period. I make a few adjustments to that. The main one that I do is I control for share buybacks, which is a big difference for Mondelez because they bought back a lot of shares during this time. They actually have bought back almost 1/5 of the company. They've reduced their shares outstanding by about 19%. So what that does is, because these are earnings per share, their shares are being reduced because the company is buying itself back basically from the public. And when the shares get reduced, that inflates the earnings growth rate a little bit. And if you do that a little bit year after year after year, like all compounding, they ended up buying 1/5 of the company back basically over the past 10 years. Then that can make a big difference. So it can make earnings growth at first glance look faster than it would be if they weren't buying back shares and maybe they were just paying that out as a dividend, right? And when they're only growing, we'll look how fast they're growing, but it's going to be a relatively slow growth rate. Spoiler alert. It's positive but slow. Usually, if I have a business that has a slow earnings growth rate, rather than having them buy back their shares into their slower growing business, I would much rather have those come in the form of a dividend where I can then choose whether I want to invest back in that business or just kind of use it as a little bit of an insurance policy in case the growth, a slow growing business is very close to a declining business, growth business, or a totally stagnant business. And generally, if a business is really just stagnant in real terms, then I want personally like an 8% dividend yield. To get the type of returns that I want, I would say most investors maybe like a 6 to 7, maybe 6.5% dividend yield for a no real zero growth business, but steady, right? It's really more of like an inflation adjusted bond at that point is what you need to is what I would think of it as. Because the problem is if growth goes negative, usually the stock price falls a lot because Wall Street will extrapolate earnings growth out into the future. I don't know what hand I want to use here, like this, right? If it's going up. But when it starts to tip down and you start extrapolating it, then it starts to extrapolate on the way down. So over time it actually shrinks. And you don't usually want to pay like a big earnings multiple for a company that's shrinking. Even if it's shrinking slowly, that transition from growing a little bit to shrinking a little bit can be quite big in the stock price. So you can lose money that way, even if you have like a good dividend coming in. And so if you have a slower growth business, I really like to get the money out of that business rather than having them buying back their shares. That's my personal preference. Not everybody agrees with that, but that's how I do it, and that's how I think about it, and that's kind of what I would want if I was going to consider buying this. And I do have a buy price on the stock, but you can see the dividend yield's only 2.37%. I mean, I don't even know if that's as much as like the S&P 500. It's probably a little better. Actually, I'll check. So I'll see real quick. Oh yeah. So it's more than the S&P 500 just as an average. Let's see. There we go. But it's not particularly high. I mean, cash is yielding we'll just call it 5%, so more than double. And then they're using the rest of their money to buy back shares for a pretty slow growing business. So to me, as I said, that's not my preference. So let's run some of the numbers now after we make the adjustment. So when I adjust for the share buybacks, I get an earnings growth rate of about 4%, like a 4% CAGR, basically, from the 2015 through 2024. So that's right on. When we consider inflation's been 3% and they're growing at 4%, they're getting about 1% more than inflation a year. Which again is positive. It's fine. But do I think it's a good idea for them to be buying back their own stock when they're only growing barely over the inflation rate? That doesn't really make much sense to me as an investor. Like that wouldn't be my preferred capital allocation. I would much rather get that back, and so I can decide what to do with it at that point, because they just don't have that many opportunities to grow. So there's nothing wrong with that. It's just you have to accept that that's the situation, right? And for me, I like to get the money back when that business gets to the later stages of its life cycle. So when I run the numbers on this, they have $3.53 in earnings, and I adjust for a little bit of the debt that they had. So instead of a $72 stock price, I treat it like it's an $84 stock to account for the debt, because if you were going to buy this business, you would have to buy that debt, not other obligations as well. So that creates an earnings yield of 4.18%, which is probably like a 24 PE or something like that, give or take. Without the adjustments, the PE is 20.45 using forward earnings. So it's not cheap at all, considering earnings are really only growing at 4% to maybe 5%, right? Pretty expensive. So, but we can run the numbers on that. So let's get over to the numbers. So the way I like to think about this is that earnings yield is 418. If I bought the business for $100, it would earn $4.18 on that $100. And if I owned the business, I could just keep that money, and the 418 would grow at about 4% a year for 10 years. And so what I want to see is how much I would have after 10 years if I just collected all those earnings myself. And you'd have about $152, okay? $100 your initial investment. So you'd actually make like $52 in profit over 10 years on $100. So that only works out to a 10-year CAGR of 4.28%, which is quite low. Now, if we can kind of see where the average market valuation is like 3.5 to 3.7 CAGR, 10-year CAGR for the S&P 500. If I look at what analysts are expecting, they're expecting like 8% earnings growth. So if I was to go with what the analysts are expecting, and I can just change that here, now we get a little closer to what the average market multiple is. And then if I don't account for any of the debt, which I can do that by changing this formula slightly. And so I'm just going to use the $72 price instead of the $84 price. Now we get almost right where the market is. So this is what the market expects, and how the market is valuing this stock right now is what I would say. They don't really care about the debt, and they think they can grow 8% earnings per share. So you can see how I'm more conservative than the market. But really, you have to ask yourself, do you want to just pay a market multiple for a company that's ultimately only growing 1% faster than inflation or so? Or even if you think they're going to grow 8% with their buybacks and everything, is that attractive? Not really. I mean, it's just not very attractive. So to me, even cash where I can get 5% right now and just kind of wait around and see if there's a recession or something, maybe I can find something better or find something with a little more growth. Or if it's a slow growing company, at least get a big dividend. You know, if this yielded 7% right now, I mean, that would be tempting, right? So, but it doesn't. so that's my thoughts kind of on Mondelez at the time. If you found this useful, hit the subscribe button and the like button. And if you have a request, drop it in the comments. I'll get it on my board here, and eventually I will make a video. Later, everybody. Bye.